ETFs, exchange traded funds. Now, these are different from mutual funds, but I'll explain that in a second. So normally ETFs are passive funds. So again, it's a pool of funds. They take a bunch of money, they put it together, and then they invest it in a certain way. But it's passive, which means that they invest it and then that's it. There's no reallocation, there's no changing the strategy, there's no sort of target, I should say. There's no actively managed target. It's just they put it there and now they wait and watch, and then if things change, they just will tweak it and rebalance it so it fits the original model. But what they're typically used for is tracking stock indexes. So you've heard things like the S&P 500 or the NASDAQ. ETFs are perfect for tracking the returns on those indexes. So what you can do is you can buy an S&P 500 ETF that every one of those you buy will replicate almost exactly the returns of the S&P 500 index. So if it goes up by 1%, this will go up by 1%. If it goes down by 2%, this will go down by 2%, etc. There are also others that are, let's say, leveraged, so they'll return either 2 or 3 times or 4 times whatever the index is, but those are a whole other story. So like I said, all they do is reflect the price changes of the underlying asset or index. So they're just tracking. It's like you shot an animal with like a tracking device, and now you're just following it wherever it goes. That's exactly what an ETF is. Typically, these also do have a management expense ratio. They have an MER, but unlike mutual funds, it's actually closer to 0.5% as opposed to 1.5 or 2% or maybe even higher. So it's significantly lower because it's passive, because they don't have a team of people analyzing and reallocating and doing all this stuff. It becomes significantly cheaper.